Hello, I'm Kelly O'Byrne and welcome to LCG's preview for the week. I'll be talking to our Head of Research, Jasper Lawler, to discuss a record-breaking start to 2018 in equity markets, the rally in oil and gold prices, US CPI, the deluge in China data and this week's US bank earnings. We'll also run down the key earnings and economic data for the week. So starting with corporate results, we have Micro Focus International and Express Scripts on Monday, Games Workshop, Salesforce and Amgen on Tuesday, Supergroup, Shoezone and WWE on Wednesday, Delta Airlines on Thursday, then BlackRock, JP Morgan Chase and Wells Fargo on Friday. Moving on to the economic calendar, on Monday there's German factory orders and Eurozone retail sales. On Tuesday, German industrial production and Eurozone unemployment. On Wednesday, China inflation, UK industrial production and UK trade balance. On Thursday, it's Eurozone industrial production and ECB meeting minutes. And finally, on Friday, from China, we'll have retail sales, industrial production, trade balance and foreign direct investment, as well as US retail sales and US inflation. So Jasper, markets have gotten off to an optimistic start.
Yeah, I would say that's right, Kelly. I mean, 2,700 for the first time in the S&P 500, 26-year highs in Japanese stocks, the Topix index. FTSE 100 hit a couple of records in the first week. So all generally, investors moving into kind of risky assets, stock market's doing well. Obviously makes sense. It's still a bull market in stocks. Nothing's really materially changed. But sometimes you can get those first few days of the year's jitters. We've not really even seen those. So obviously sign of confidence. I think the kind of backdrop to it and a theme that's emerging a bit is this global growth pickup. And so we saw emerging markets outperform even the US markets last year, and high growth companies like tech stocks doing well, and they're continuing to do well so far, at least in the new year.
Yeah, okay. And it's not just the equities though. Arguably the bigger rally has been in, say, oil and gold.
Yeah, absolutely. So, I mean, gold just shot higher in those last 3 weeks of December, and it's continued into January. A lot of it off the back of weakness in the dollar, but I would say some underlying demand in gold as well, which we hadn't seen up until recently. So there's been data showing flows into gold ETFs, for example. December and January are typically good seasonal times for gold. And obviously, again, going into the new year, no one's holding back in terms of stock markets. But if there is going to be a pullback this year, you want to be hedged with gold, I suppose. And a lot of people have been talking about the relationship between a bit of a crash in Bitcoin prices and gold rallying. I wouldn't put too much emphasis on that. I think there's a certain sort of tinfoil hat investor maybe that's like betting on the end of the world with gold and Bitcoin investments, but I think that's probably a pretty small minority. Probably doesn't explain the rise in the gold price by itself.
Yeah, of course. You've called the US CPI on Friday the most important data point this week. Why is that?
Well, we just had the FOMC minutes from the December meeting. And so what the Fed are continuing to do, and obviously this is under Yellen, so things may change a bit when we shift to the new Fed chair, Jerome Powell, but what they're doing is calling in the low inflation transitory. And so this is obviously inflation data. What they're saying, the Fed is saying, we're setting up for 3 rate hikes this year because we expect inflation to pick up again because of the tight labour market and wages pushing inflation higher. The market doesn't think so. The market is pricing, according to Fed funds futures, 1 rate hike this year. So someone's wrong. Last year actually was the market. The Fed did hike 3 times despite the low inflation. So the question mark is, do they continue to do that again? And this data will tell us a little bit about how much they need to ignore the data in effect to still do those 3 hikes.
Yeah, okay. But it seems like most of the data is coming from China though. What are the highlights?
So the data covers all the bases really. So you've got the new economy in terms of retail sales, you've got the old economy in terms of industrial production, and then just the foreign direct investment was obviously kind of global sentiment about what's happening in China. That probably is the most interesting, just because we have come out of this People's Party Congress. It's the 5-year plan after China. They've de-emphasized growth a little bit, maybe some more emphasis on structural reform. And so maybe international investors are not going to be quite as keen to invest in Chinese growth, perhaps as much going forward. This FDI data will tell us a little bit about the short-term reaction to that change in government stance.
Yeah, of course. And so we're headed into the fourth quarter US earnings season. And there are a couple of big banks reporting on Friday, I think. Yeah.
Yeah. So obviously, generally, that we're expecting quite a big uptick again in earnings in 2018. So that underpins this rally that we're seeing in stock markets at the moment. For the banks, so we've got Wells Fargo, which is more of kind of a traditional bank, if you like. JP Morgan obviously has its investment banking arm too. For the investment banking side, it's all been about the low volatility in markets. Obviously, that's bad for trading revenues from the bank. So that will probably be another key theme. It was pretty darn unvolatile in markets in the fourth quarter. So that probably is going to be a drag. The question for investors will be current scenarios versus what's happening in the future. If interest rates continue to rise, we want to see some evidence that net interest rate margins are also starting to expand to reflect that. And also there's, obviously Trump got through the tax cuts just by the end of the year. Interestingly, it's already been priced in to some extent, but some of the banks, Goldman Sachs notably, also American Express, have said that actually that tax plan is going to be a hit on near-term earnings because basically because of the kind of deferred earnings on their foreign investments. And they had something called deferred tax assets, which were basically almost credits from old losses that they were using to offset against current profits. So because that will be based on a lower tax rate now, you're getting less of a credit to offset against. So actually the short-term hit will be negative from the tax plan, but still they're saying longer term it's going to be good, lower corporate tax rate, will obviously help the banks themselves, but also help the companies that they're lending to.
Okay, thanks Jasper, and thank you all for watching. If you wish to have these videos as they're released, please follow LCG on social media.